Recently, Chinese real estate companies have released their performance reports, and overall sales are generally sluggish. The largest, Country Garden Holdings, reported a 37.35% decline in sales. On December 5th, Country Garden released unaudited operation data from November 2022. The report showed company sales at 26.01 billion yuan, $3.73 billion, a 22% fall compared to October with $4.7 billion. In the first 11 months of the year, the giant racked up nearly $48 billion in sales, down 37.35% year-on-year. The Guardian reported weakening performance of the company in August with a 96% profit plunge. At that time, the company blamed a severe depression in China's crisis-hit property market and said only the fittest can survive. Until now, there has been no sign of recovery. According to the data from the China Compass Institute, from January to November, total sales of the top 100 real estate enterprises reached slightly over 6.67 trillion yuan, $957 billion, down 42.1% year-on-year. China Real Estate Residential Information Service Platform, CRIC, analysts expected the annual performance of the top 100 real estate companies to drop by more than 40% year-on-year. Although the regime has adopted some measures of support and relaxation, overall sales of the entire market is still sluggish due to gloomy market demand and purchasing power. The international rating agency Standard & Poor's downgraded Country Garden's credit rating from BB+ to BB in September this year.
Due to a sell-off in the debt market that has caused people to sell their fixed-income investments, high-rated onshore corporate bonds are yielding more than they have in over a year. Yields on 3-year yuan notes with a AAA rating rose to 3.16% on December 5th, the highest level since November 2021. Yields on most domestic corporate bonds with the same rating jumped at least 10 basis points on December 6th. The withdrawal from local high-grade corporate debt began last month when a sell-off in sovereign bonds prompted retail investors to redeem mutual funds and wealth management products that also contain such notes. The country's bond market has been influenced by investors' changing perceptions of inflation, as Beijing may be drawing to a close its monetary easing program that has driven yields lower this year. In contrast, yields steadily increased in 2022 throughout much of the world, as central banks have raised interest rates. Ting Meng, a senior credit analyst at ANZ Bank China Co., said, "The sell-off is mainly due to the easing COVID policy outlook, as investors are seeking higher returns and moving to riskier assets such as equities." According to analysts at China Merchants Securities Co., including Yin Ruizhe, in a December 4th report, outflows are still having an influence on the onshore credit market. They added that public funds are seeking to switch to assets with greater liquidity,